that's one of those that are not that simple to answer, but let me give you my standpoint from which I always start my research in general. And it's that I don't know. Basically, I don't know how crypto will evolve. I don't know if in 2 3 years in crypto there will be more trends, or if crypto will be going sideways for 2 3 4 years. We just don't know. The crypto is such a young market that if we want to be prepared, we just have to trade basically everything. Because yes, right now, if I should choose one strategy, one type of strategy, I would probably trade trend following. I would trade momentum, shorter term momentum, like 7 to 10 days, let's say. But if you see, or if you check just last 5 years in crypto, you can see that just momentum has already evolved a bit. It went from a huge result on 1 to 2 3 days momentum, which basically means that you make your predictions or your trading models based on very short-term momentum, 1 2 days. And this type of momentum stopped performing in 2022. And right now we are on 7 to 10 days momentum. What I want to say with that is that things are changing. Markets tend to be more and more efficient over the time, and usually it brings some involvement from momentum type of trading to mean reversion type of trading. So that's why we want to trade basically everything, every possible directional approach, to be prepared and to be able to manage the portfolio as a whole, not being focused on one trading style only.
I don't care how good you are in anything, you don't have discipline, you ain't nobody. Right. You're nothing without discipline. Because you give up under the slightest struggle without discipline. Discipline is doing what you hate to do, but do it like you love it.
Hey everybody, we're with Pavel from Robuxio. We were doing the trading panel together for a while, and the thing that's really interesting is he runs a systematic fund for crypto, and he trades. It's not just Bitcoin, it's not just Ethereum. He trades them all, so lots of different coins. Maybe not all of them, like probably things that are too liquid, but he trades a lot of different ones, and also his back testing. His knowledge base is huge. So if you guys are on Twitter, you guys have to give him a follow as well. I'll put that in the description, but he has a lot of great information, and even like his ideas of mean reversion against trend following. Like we'll go over all that today. So first off, how are you today, man? It's glad to have you on here.
I'm great. I'm great. Hello. Thank you for having me here. Well, yeah, let's start. Let's start. Everything is going well. We can talk about whatever you want.
Nice. So we talked about it earlier. We're just gonna let this fly. And you guys know me. That's kind of how everything goes for me. And so as we're kind of just letting it fly, I think the thing to first start out is, you came to your strategies and you run a robust trend system, but also you have mean reversion strategies. And I know like I'm on the outside of all the trend following conversations because I do the same thing. I have different systems, I have different strategies. I think the best way to trade well is to have some different strategies so you have smoother returns. How did you kind of come to this diversified style of trading?
That's a very good question. That's one of those that are not that simple to answer, but let me give you my standpoint from which I always start my research in general. And it's that I don't know. Basically, I don't know how crypto will evolve. I don't know if in 2 3 years in crypto there will be more trends, or if crypto will be going sideways for 2 3 4 years. We just don't know. The crypto is such a young market that if we want to be prepared, we just have to trade basically everything. Because yes, right now, if I should choose one strategy, one type of strategy, I would probably trade trend following, I would trade momentum, shorter term momentum, like 7 to 10 days, let's say. But if you see, or if you check just last 5 years in crypto, you can see that just momentum has already evolved a bit. It went from a huge result on 1 to 2, 3 days momentum, which basically means that you make your predictions or your trading models based on very short term momentum, 1 2 days. And this type of momentum stopped performing in 2022, and right now we are on 7 to 10 days momentum. What I want to say with that is that things are changing. Markets tend to be more and more efficient over the time, and usually it brings some involvement from momentum type of trading to mean reversion type of trading. So that's why we want to trade basically everything, every possible directional approach, to be prepared and to be able to manage the portfolio as a whole, not being focused on one trading style only.
No, I like that because I think it's generally very important to one, start with what you first said. I don't know.
Yeah.
I think generally, like when you're good at trading, that's where everything starts and ends.
Mm.
It's a thing that I have tons of conversations just like you do with different traders, different people who run money, or they're individual traders, or they're analysts. Um, and the ones that struggle the most are the people who say, I know this, or the market isn't doing what I think it should be doing, or the market's mispricing. Like words like that are insane. And instead of just saying, I don't, for example, we talked about this before, the cocoa trade.
Yeah.
I've gotten a lot of people who are like, "Oh, great job," and it's like I'm just running a long-term trend following system. I understand the fundamentals well. I grew up in Ohio. One of my first parts of this business was to analyze markets for farmers. And
Mm.
so as I've been analyzing markets for farmers all this time, I could make up a million reasons why cocoa should have ran the way it ran, and I could say, hey, yeah, I did a really good job on this one. I killed it, like, and I'd look really
Yeah.
cool. However, it's a lie. It's just, I don't know. My system is right only a certain amount of time, and sometimes I catch those big winners because my whole goal is really to catch those
Mhm.
outliers.
Mm. Well, I think that confirmation bias in general is one of the biggest weakness of advanced traders. So that's really something we as a traders should be really aware of, because I was in discussions with many advanced traders, even hedge fund managers, who suffer from a huge confirmation bias. And I somehow understand it, because you also have to believe in the solution you are trading. So to me, it slightly makes sense. But on the other side, if you want to advance and if you want to survive, especially on such a quickly changing market as crypto, you just have to be as open-minded as possible, because one thing is sure, and it is that the market will behave differently in 3 5 years than it is behaving right now. So that's why I always try to break down my trading models basically, and I'm trying to breaking them down basically every day. With every of my research, I'm trying to break down one parameter or another variable, and this is basically the way how I'm trying to stay on the top of the game.
No, I love that. And if you I like the way you said that when you have to have some belief in your trading strategy and methodology. And like it's very hard for me because especially just with my background, it's very hard to use how that is. And once again, I had a conversation with somebody, this is probably a couple years ago, and they were like, so how do your system's going to continue to work? And I'm like, it's through a back test. He's like, well, that doesn't tell the future. And I said, yeah, it doesn't tell the future. He says, well, and he keeps kind of nagging me about it. I'm trying to like come up with an answer. And the only thing I could say is faith. Like I was like, maybe it's faith, at this point. And it's really like you're right. Like you have to have some sort of faith in your strategy, or you'll bail on it when times get hard, times get rough. Whether you're fundamental, technical, quantitative, whatever type of trader you are, if you start to, it's kind of like it's funny. I'm going to use a terrible quote from a terrible show that was way too popular, but it was Game of Thrones. There's a point where the general basically says, hey, I was wrong on something and you were right. And he goes, but I can't doubt myself, because if I doubt myself, that's the end of you, that's the end of me, that's the end of the whole castle. And like that's kind of how I think about it with trading, is like you still have to continue to have this ability to stay with it and stick with what's going on, because at the end of the day, it's like what we talked about earlier. The more diversified your strategies are, the different market environments you can make money in.
Yeah,
However, go
sorry.
ahead. Go ahead. No, you go ahead.
Plus, it's very good idea. But one thing that is even more important for me is to have really many strategies, because then I don't have to have such a big faith in one of them. I know that all of them are made with some robust approach. They went through really huge robustness testing procedure. Uh, there is common logic behind them. And even then, I expect that some of them will for sure fail in the future. But if I trade 15 strategies in the portfolio and one will fail, I don't care that much, because our clients won't even notice, honestly. I will, because we are running on the back end some day-to-day and week-to-week analysis to see if the strategy is trading well against its benchmark. But on the portfolio level, you won't even notice. So this is what is giving the trust in the system or in the process that we are running, because we are running many strategies, and we will also add more when they will go through some incubation time and so on. So this is how I like pushing my belief in trading in general.
No, that's great, because, and I like the way you mentioned that, because it's important to understand, like, is it just me who's looking at the system and getting upset because it's losing money, or is it actually losing money against its benchmark? It's kind of like if you're looking at the S&P 500 against energy, over 30 years, you would find periods of underperformance, and you could go, okay, well, maybe I didn't want to hold it during those times. You have to have a benchmark of something, and there's lots of benchmark, and that's the thing that a lot of people might not know. There's benchmarks for all these different strategies. There's benchmarks for trend following strategies, diversified systematic strategies, and so on. So there's a lot of benchmarks for these. So the more you can go look at that, and then go back to your strategy and see how it's working, competing against it. And it's not always going to outperform it. That's the thing. Like you don't want to get too stuck into, hey, I always have to be outperforming my benchmark. You just want to make sure it's in line. It's not just falling off of a cliff in comparison. So I really like that, and the idea of being diversified. So you run, can you name just a few? You don't have to name them all, but just name a few of the different systems and strategies that you're running.
Well, we are running short-term breakout strategies, 1 to 2, 3 days of average holding time. We are running longer-term momentum strategies and classical trend following ones, and then mean reversion, everything long, short. So that's basically it. Basically everything we can from the directional side of trading, I would say. The only thing we are not running is pair trading right now, because I haven't found robust enough solution how to know. No, I don't like to use the word no in trading, but how to have some probability in future work of pair trading in crypto, because we just don't have enough data, honestly. And it's pretty simple to find some over optimized, great, I would say great returns, but I'm not sure in the robustness of the idea. So that's why we are not running it right now. It can change in the future, but not now.
I also really enjoyed your you'll put out your drawdown periods per strategy, and you had
Yeah.
one that came out that you put out, which was on mean reversion compared to trend following. And it was showing that trend following has better returns, but you're stuck in a drawdown for a lot longer. And then mean reversion doesn't have as great of returns. However, you're not stuck in a drawdown nearly as much.
Yeah.
Do you always kind of look through all of these different scenarios? I mean, we all kind of look at drawdown, but you seem like you really dig deep and deeper than most of the people I talk to. I dig very deeply, but I think you're the one who actually digs deeper than I do, which I find that fascinating because people always think I'm a psychopath the way I do things, and I'm like, well, I got this guy over here, but really, like, I really like it because once again, it's like you can't know, like, once again, like you said, you can't know, so
Yeah.
don't use it. So you can't understand the probabilities of future returns, but you can dig this deeply to figure out what the future could possibly look like, and that's the best we get. So when you're looking at these mean reversion drawdowns, trend drawdowns, how do you put those strategies together? Like, how do you weight them in your portfolio?
Well, firstly, very shortly to the drawdowns of different approaches. For me, why it is very, very important is because if you understand when your strategy or the strategy group is in drawdown, when it is creating drawdown, and when it should be performing, then you cannot be surprised if your strategy is in a drawdown, if market is sideways and you are running portfolio of trend following strategies, for example. It's very normal. And this is also the reason why I don't like put some final metrics to, for example, when to switch off some strategy. Let me give you an example. You run your backtest on 20 years of data on, I don't know, trend following stock strategy, trend following long strategy. And you can see that the maximum drawdown is 1.5 year for this single strategy. But you also see that in the last 20 years, the stock, basically stock market was sideways without any trend for x years. And if in the future the stock market will be in the sideways movement much longer, you have to expect that your drawdown will be also much longer and probably even deeper. Does it mean that your strategy stop working? If the other trend following strategies are working similarly, then it's perfectly normal and it's behavior you have to expect. And that's why I really tend to understand every single strategy as much as possible, because then, and now get back to your question, then I can properly build a portfolio. Then I can know somehow that if the logic of the strategy is this one and it tends to make money in these conditions, then I know that the correlation coefficient is not lying to me, for example, because yes, you can build your portfolio only based on correlations and volatility, which is the normal approach, I would say. But especially in crypto, where you have like 5, 6, 7 years of proper data, you have to use common sense in the sense of knowing what the strategy is exactly built for, because then you know that you are building the portfolio the proper way. So a more specific answer would be that the portfolio is made that way to deliver the best performance to drawdown or volatility ratio we can do with our strategies right now. And we are playing with weights that way that, for example, the most volatile strategies tend to have lower weight in the portfolio, and those that are slightly more correlated, even logically, in the portfolio between each other, have again slightly lower weight, because they could push the volatility higher in some future event that we maybe even cannot expect. Because I always say, and it's not my sentence, that the biggest risk is the one that we cannot imagine, the one we didn't see in the past data. That's usually the biggest threat for trader.
No, I love that. And another area to go here. So like I mentioned earlier, I've never really fit in with the pure trend following types because of my affinity for different strategies. And some of them are trend following plus nothing, that's a big thing for Jerry Parker. And while I don't hate on it at all, I know that there was massive periods of underperformance and
Mhm.
massive hard times in the middle of all of that type of trading. And for me, that's part of the reason why I kind of created the strategies the way I did. And just like you said, just the understanding of how will my portfolio do in this environment, that's really important. And not only for the returns, it's also important for your own expectations. I can sit on my hands a little bit better if I'm going, okay, well, I know that during a market that looks like this, my portfolio returns usually look like this, and therefore I'm not expecting these crazy years like I was expecting, at certain points when the market's trending very powerfully. So
Mhm.
I guess for you, it's I guess I'm asking, when you looked at all the past traders and past systematic traders, is that kind of what you saw and were like, hey, maybe I want to run a little bit more diversified? Or did you have a mentor who did it a little bit more in a diversified way?
I have not specific mentor. It was slow process that hurt. Very honestly, I lost some money on this way. I made some money on this way, but again, I think we have to get back to the basics, and it's really about. Even though I love trend following, I love the simplicity of the solution. I also see how trend following is evolving. I was in a few discussions in the past. There are very clear data where you can see that trend following is performing worse and worse on stocks, on commodities, and it's normal. Mean reversion is again and two performing worse and worse.
Mhm.
So that's why I don't see the reason why I should stick with one solution, especially if I want to provide solution for one asset and I want to give as stable results as possible. Of course, it has some thresholds. It won't be stable on a monthly basis, not even on quarterly basis, but as stable as possible. So
Mhm.
yeah, I don't honestly I don't see the reason why I should run trend following only, for example, or mean reversion only. I could see the reason for marketing purposes, but not from traders' point of view.
Yeah, return wise, it's everything, and I think you and I have talked about this before, where it's not about for us, it's not about making all the money in the world or having the biggest fund in the world. We just really enjoy trading. We want to do our best at that, and I think if that's the case, then running a fund where everybody's going to understand it perfectly is just never going to happen, and
Mhm.
that has to be okay with us, because it's even like my newsletter. I'm talking to retail clients, mainly, and talking to retail clients, there's a lot of people who get on there and are very like confused and upset and don't
Mhm.
understand it. And why am I not doing more? And it's
Mhm.
like, this isn't a signal service. This is real trading. Real
Mhm.
trading is boring at times. Yeah, maybe if it's a very short-term system, but me running a very long-dated system, that changes things.
Mhm.
So, when we're trying to, if I just said, hey, it's just I run a breakout system and that's it, then everybody would kind of understand what it is. But when you say, hey, I run a breakout system, but also I run a volatility squeeze system, I also run a mean reversion system, I run a false breakdown system, like you start to go down this list and people are like, wait a minute, what was the first one you said? especially client wise. Clients look at us like we're like, mad scientists basically, and they're like, I'd probably rather invest with the guy who just said that he buys things because they have low PE ratios or something ridiculous. You know,
Yeah.
people like to understand things, and that's totally okay, but that doesn't mean it's the best way to do this.
No.
And so getting to the trend following aspect of it, though, I thought that was interesting what you brought up, and that's what I've seen as well. Is like, I find so I have a model and it's the ultimate thing that every trend follower will tell you is the dumbest thing to do in the world, which is filters.
Mm.
Not that I filter using, like some filters, what they're usually talking about is like a stocks above the 200. I only take long signals if this is above a 200-day moving average or something.
Mm.
That's not the signal I'm talking about. I run an intermarket analysis signal, which tells me basically what I should be buying and what I should be
Mhm.
selling. Now, this helps me out a lot, but every trend follower I've ever talked to about it, they get like, and it isn't even like, I'm just kind of saying what I do. I don't care if somebody likes it or doesn't. It's not the point. I back
Mhm.
tested it. It works well. I'm happy
Mhm.
with the way it's performed. But sometimes I get very upset about it. So it's
Yeah.
it's kind of interesting that they're kind of stuck in the way of like, hey, this is exactly how you're supposed to do this. And if you're a systematic trader, you trade 100-day or 200-day breakouts. I mean, I can't tell you how many people in that industry run the same exact strategy.
Yeah.
Exactly, like it's all almost the same, and that's the thing that's kind of funny for people who are listening. Like, it's literally 100 buy on 100-day for, so three quarters of it, 33% positions, buy on 100-day highs, add on a 150-day high, full position
Mhm.
on a 200-day high, sell on a 50-day low, and that's
Mhm.
it.
Yeah.
That's their whole strategy. So it's mind-blowing that, like, of course there's different ways to do it, and of course there's possibly a better way. Once again, not making fun of it, but I'm just saying, like, there's no reason to really hate on all the other strategies. And I think,
Mhm.
so I guess another thing to talk about, since we were talking about drawdowns, is how do you, mentally handle a drawdown period? You talk about, I liked, when you were talking about the different strategies, and you also know the level of drawdowns. So can you talk about the level of drawdowns per strategy, and then how you handle a drawdown period?
Well, I don't care that much of a single strategy drawdown. Like, don't make me wrong. I'm looking at it. I know in what type of drawdown the strategy is, and if it is, again, which it's benchmark, which basically means that for every strategy we run in the portfolio, we have similar strategies that are also running, and we can compare the performance between each other. So that's helping us a lot to understand if if everything is with or without sync. On the portfolio level, honestly, drawdown is never nice. Drawdown, you will I don't think, maybe I'm trading 18 years right now. Maybe if I will trade 40 plus years, it will be different. I'm not like nervous about drawdowns. Of course, if you are on a new all-time highs, it's much better thing. But what I'm always getting to is back test, checking that everything is as it should be on single strategy level and on the portfolio level. If we, for example, didn't make any mistake in terms of correlations, if there is not something strange in the market behavior that we haven't seen before. Because to me, what is important is to look at single strategy, to look at the portfolio. But what is also important to me is to see what is going on in the market in general. So I'm running some very basic models on monthly basis, based on which I can see how crypto in general is trending, if it is trending more or less than in the past, in last 2 3 4 years back. And then I'm also checking volatility on monthly basis, and based on it I can understand the market better. And if I can see that nothing is changing that much, or if I can see that the volatility, for example, let me give you a very specific example. We had some bull market in since, let's say, February to April on crypto, and we made like, based on portfolio, between 30 to 60, 70%. Is it good or is it bad? I don't know, honestly. But if I check this type of movement, for example, in and compare it to 2021, I can see that crypto was trending similarly to this period, but with much higher volatility. So of course, I can expect much smaller, even though still huge, but much smaller results compared to 2021, especially in this super volatile period. So yeah, you just have to understand things, I would say. I think that this is the problem of most retail traders, that they think that trading is easy. It can be simple because you can really run simple models,
Mhm.
but to be able to manage everything, you have to understand the market on very high level, I would say, especially if you want to go through drawdowns and you don't want to cry every evening or so.
Yes, I think that's the thing, and you're right. Retail traders, the thing that they get into a lot of the time, and I did it at the beginning too. I'm not making, hating on anybody, and we all do it at the beginning, which
Yeah, sure.
you don't understand, those type of periods. And not to mention, the bigger thing that they don't understand about people like us is that if you give money to a professional, this is the thing that I'm sure comes up for you, came up for me, still comes up for me from time to time, which is you gave money to a professional, so therefore you think that money will come every single day, every single month, every single quarterly statement. You'll be making money all the time. And it's just the difference between a retail and a professional. One, we understand our strategies and systems so well that we know how to keep our money. It's not that we make all the money in the world, but we also understand that something like, you're in very volatile assets, like the crypto market. If you can, and like you create strategies that take advantage of these massive moves. And it's not even about, you taking advantage of them and that being the biggest part of it. The biggest part of what you do probably is keeping that money.
Yeah.
If you can catch those huge moves and very little bit of the reversals, you're going to make a lot more money than the person who, people always say, I wish I was the person who bought Bitcoin in 2010 and, had it till today. It's like, well, you really wish you were the person running a system on that from all the way back then to today, because that would be the most ridiculous
Yeah.
trade ever. I was talking to a guy and he was younger. He was under 20 years old at the conference I was at recently. He's under 20 years old and he's talking about, how he's gonna buy Bitcoin and kind of hold it for, years and years and years. And the risk there is so high. And not to mention you also trade all the alternative current, the altcoins. So when you trade all the altcoins on top of it, now your volatility levels are rising even more. Now you have the possibility of these coins going off the market. So all of these things mean that it's even more important to manage your risk in these trades. Not to mention you have a bunch of interesting strategies that actually manage risk. Can you go over some of those? Like you mentioned some to me that were just like beyond being safe in that realm. And so I'm wondering, just listening it to people could be very interesting. So, what are some of those strategies for you to risk manage in that space specifically?
Well, specifically, so first thing that I would say is the biggest difference between professional and retail trader is that professional is always thinking about risk first. This is the most important perspective you have to use as a trader. So, of course, if you want to start crypto as we do, you have to write down all the possible risk and always try to cover the biggest ones. In crypto, for sure, as you said, the biggest one is being allocated with too big allocation into one single coin. And it's, but on the other side, of course, if you don't allocate that much, you are giving up a lot of potential profits. So how to deal with it? Basically, one of possibilities is that, for example, we trade very small positions per one coin per single strategy. Let me give you an example. We trade 15 strategies. Every strategy can trade up to 20 open positions, and one position can have maximum based on the portfolio, because you can choose from low to medium to high risk portfolio. So one position can trade between 1 to 2.25% of your account without any leverage. So that small is our allocation per one coin. And this is how we are able to try the market basically with, for example, one strategy that is slightly more aggressive and, for example, doesn't have any regime filter. But if the conditions are getting better and better on the market, regime filters are able to switch on some of these other strats and then can slightly add to the portfolio on this single coin. So our maximum allocation per coin in some occasions can be about 5% or so. So to me, it is really about different time when to enter into the coin, and how you deal with hedging your overall portfolio. Because let me give you a specific example. We have strategies that are really, I would call them money makers. They are really for making money in the portfolio. But then we have strategies that are in the portfolio more for the reason to hedge it. For example, you have breakout short strategy. You would never ever trade this strategy on the single basis because the equity curve is just horrible. But as a diversifier for the portfolio, is working perfectly, because I'm thinking about this strategy as an insurance. You are basically losing some money very slowly in strong bull markets, which I don't care at all, because in bull markets I'm making a lot of money with trend following, momentum strats, and so on. But once the market falls heavily, these hedges is adding up very quickly into the short positions, and you are at least partially filled, or sorry, filled, covered or hedged. Or what we are using is mean reversion short strategies. Again, especially in crypto, pretty risky strategy. But if you use it for hedging some of your open long trend positions, it is working perfectly well, because you have to understand one thing, especially in crypto, especially on this exponential asset, compounding effect is the number one reason that is making all these miracles of 100% plus average performance. Because if you are able to stay with low drawdowns and take it advantage of volatility and inefficiencies, then you can really deliver nice profits.
No, I love that. And it's really like, and even you've mentioned to me before another one, which is, having multiple exchanges.
Yeah,
Uh
of course, that's another one.
yes.
That's basically, yeah. So there are two biggest risks. One is being too over leveraged or too exposed to one coin. Another one is being in one exchange with all your assets, basically. So that's why our clients can trade of more exchanges, because yeah, that's very important for sure. And we are adding more exchanges during the time, as usually as our institutional clients want to trade on some very specific one. We prepare the solution for it, run it in very short incubation period on, for example, 1 to 2 minutes chart, to get a very lot of quick feedback, and then we release it for all our clients too.
No, I love that, because I think in general, I mean, when people think about anything to do with your money, you have to think about it in a very diversified way. Whatever it is, for myself, it's and I don't know everything. I think that's the thing too. People feel like they know so much, so therefore they're going to invest over here, invest over there, and it's like, I stick to my niche, which is trading futures. That's what I do. and then my money's in the futures fund, and that's where I trade it. And then also I have, commercial real estate, but I have a friend who does that, and so we're
Mhm.
involved together doing projects there. I have different assets that I hold exclusively over time that just gain value over time, not gain value every single day. Just over
Mhm.
time, they will most likely gain value unless something really crazy happened. And then also you have, especially in the U.S. right now, I'm sure it's everywhere right now. You have the ability to buy bonds and
Mhm.
make a good yield on them. I have boring investments like that too, and not so boring ones. Like a couple years ago, there was the I bond that came out, and you could basically get a 10% rate in these I bonds. So then you hold some of those. And my
Mhm.
main point is like, whatever it is, like diversify. So if you were to get hit badly in one area, it's not going to affect you terribly. And
Yeah.
it's the same way for you in the fund, which is, hey, we're in all these different exchanges. If something like unforeseeable, like an FTX thing happened or so on, I'm actually okay. It won't be fun, and the things like that never are. But being prepared for the worst is what we do. It probably will never happen. There's
Mhm.
probably, and I'm sure you've even worked this out, which is there's probably markers that kind of show you when an exchange is getting close to the end already. So you'll probably never be in a position where it goes to zero and then you've lost all your assets. But you're prepared in case that does happen, which is the best way to do things. Like that's how you do
Yeah.
this well and at a high level.
Exactly. I would say everything is about probabilities and the impact. You have to, as a trader, you have to think about it. What's the probability that something will happen, and what is the impact to your portfolio, to your money in general, and to your life? And this is the concept that I'm using. Yeah, basically even in my life. So yeah,
Yeah.
because if you are a trader for longer time, it is somehow this probability type of thinking, it's getting to your blood way, and you even don't know. So
No, I love it because it's you have to have that inside of you somewhere, and I guess another question is, where do you think when you were a kid, did you ever think like this? Was it like I'm not saying you have to have I had my own crazy childhood.
yeah,
Um but did you ever think like this? Was this something that's kind of in you to, back test things to this crazy level, or to be so dedicated to figuring things out in this way? Was this something that you were always like this, or did this come about later in life?
I always loved math and stats in general. So it was, yeah, I was on this high school type of you know what I mean, uh, like um, like inter-school type of fights in math and
Yeah.
stats and so on. So it
Debate.
was some, yeah, debates that was always part of myself. And I always loved charts in general. I can remember it since I was 15 or so, 15, 16. I started watching it at charts basically everywhere. But other than this, I was more this type of adrenaline seeker, and I always trying to find freedom in life.
Mhm.
Honestly, that was also the reason why I started with trading, but I didn't start on the right end, I would say, because I started with discretionary trading, which is not giving you usually not that much freedom as one would want from trading. And the only reason why, or at that time, it was slightly different. Algo trading was not that usual as it is right now, but there were some bot type of trading, but I just didn't understand. And I thought, I can remember until now that I was saying myself, yeah, you cannot program. Maybe let's stick with discretionary trading, and you will solve it out in few months and whatever. Yeah. So it took a few long years to get some point, and yeah, and a few more then. So
That's great, because I mean, that's my story too. Is I thought I thought I was gonna figure this out, and I remember thinking of my systems kind of as like bumpers on bumper bowling, meaning, I basically if you're playing bowling, you can put these blow up lanes in the gutters so
Mhm.
you don't lend your ball into the gutter. And so
Mhm.
that's how I thought of my systems. And then one day I started just running my systems and then taking my own trading, and my systems were ripping my face off. Like they were just doing so well when I was doing so badly. And I was
Mhm.
like, you know what? I don't know anything about the market, like I'm gonna go back to that sort of thinking.
Mhm.
And I think it's not that we people like, because everybody always jokes like, we don't know anything, and I think it's because we know that it isn't predictable. It isn't
Yeah.
something where I can. People always talk about natural gas, and I always find that funny because, if I look over my stats over the years, that's one of the places where I've made the most money over the years. And it's because I just run systems. I do
Mhm.
not try to guess. I do not try to size big. Like every time I see people having trouble with things like natural gas, it's because their size is so large in
Mhm.
the most volatile product in history,
Mhm.
besides Bitcoin and crypto. It is one of the most volatile products in history, and their size so large. And of course, you're getting your ass handed to you. Of course, the market's chopping you around. Of course, you're getting stopped out every 5 seconds.
Mhm.
But if you just go, okay, I have a systematic way to size this position. I have a systematic way to set up a stop loss. Even though, we talked about that the other day, which was, I said I completely agreed with you on your idea of not using stop loss, even though I use stop losses. The people who use them very poorly for the most part.
Yeah.
You have to use that if you're going to use a stop loss. The only way I think you can use it well and properly is to have it be that thing that's it's just a size your max loss per position,
Mhm.
and it's so far away that it should probably never get hit. Like your
Mhm.
exit should always come first. It should never be hit.
Yeah.
Um, and so, go on your end too, because you talked about stop losses too, and you
Yeah.
have some great research, and you're a systematic trader that doesn't use stop losses. So I'd love to hear your angle on that a little bit more for people who didn't read what you wrote the other day.
Well, stop loss is very, very interesting topic. We could probably talk about another hour or more because people don't understand. Many people, not all of them, don't understand the difference between trade management or exit management and risk management. These are two completely different things. Stop loss is great tool or one of great tools for money management or risk management, but one of the poorest ones or the worst ones for exit trade management. Why I thinking what I think with it, and now I'm talking about these stops like sell stop orders for long position, basically stop orders that are in the market that are telling you that if market gets 2% below, you get out of the trade. Run an analysis on any trend following strategy or momentum strategy or mean reversion strategy, and over the large numbers or big data you will get one output, and it is that if you would exit at the end of the day, if your stop loss threshold would be touched, you would get a much better performance. Why? Because markets tend to revert on lower time frames. Again, this is stats that not everyone understands, but if you go to lower and lower time frames, you'll find out that markets tend to be more and more mean revertish. They tend to mean revert more and more. So that's why it's even logical that if something hits or gets through your stop loss level, there is much bigger probability that at the end of the day you will end above your stop loss threshold. So
Mm.
and this is valid over futures, stocks, crypto, it doesn't matter. Of course, it depends on how you trade. It doesn't mean that you shouldn't use your stop loss. It means that you should think about how you use your stop loss, because as you said, this is, for example, great example on leveraged products like futures, for example. You should have some type of stop loss in the market, but it should be really like last break, I would call, or something like that. But it is very poor exit management type of approach, because it just doesn't work as one thing that it works. The same with profit targets, by the way. It's the same concept, especially for trend following or momentum type of strategies. Profit target is again one of the worst exit you can use. But everyone, or not everyone, many are using it because it's the simplest. Of course, you don't have to think that much. Give me 5% stop loss, 10% profit target. I will get 2-to-1 ratio. So it means that I can be only profitable in X% of time, and boom, that's great. But this is not how market is behaving, unfortunately. It doesn't have to be that difficult on single strategy level, but you still has to understand it. So
No, I
yeah.
love that, and it's really it's funny. Also, I always talk about using the end of day stops or end of week stops even,
Mm,
and people get so like confused when I'm talking about that. And they're like, "Wait a minute, why would you do that? It's through your level." And it's because of what you said. Like most of the time, those levels where our stops are, it's not magic, and they're able to be seen. And you'll hear this from old floor traders that talk about the
mm,
piranhas. Basically, it's people buying up things right after it hits a major level. And
mm,
most of the time when things break down, it's breaking past a major level. And that's a lot of the time where our stops will be, whether you're using trailing stops, technical stops. Like people always say, it's great, you should use technical stops. It's like, it's the same exact thing. Like
mm,
you're using a technical stop, you're finding a level and you're going, okay, I'm going to put it right at that level where everybody can see it.
mm.
It's not magic, and it's not rocket science either. Just keep it
Yeah.
very simple. End of day stop, end of week stop. The weekly close is always the most important to me in my time frame.
Mm,
And if you can do it that way, you're once in a great while, there's going to be one that slips through that you're going to be like, I wish it hit there. Like once in a
mm,
great while, that'll happen to me. But for the most part, it'll break that level. It'll go right back above it. Chop around sometimes. Sometimes it'll go back up and I'll get my actual exit to get
mm,
out. So I think that's great. And also what you mentioned about profit targets.
mm.
I fucking hate profit targets.
Yeah.
I talk about it all the time. People love it because it's something to talk about, or I had a letter that was one of my most read letters, and it was like I forget I got a buy signal in the Nasdaq. It was 23 last year, and I said, at some point the market will hit an all-time high. Now I just had a buy signal. I was just making a clickbaitish headline for it, and once again, that was the most read article I ever wrote.
Mm.
And it's ridiculous because it's not true. I'm not really predicting anything. I'm just stating something. But people love targets. They love, oh, it can go to all-time highs. Look at, you called it. You're seeing the future. It's like nobody can see the future. I had a very
Yeah.
interesting one the other day.
I
Uh,
think that
go ahead.
profit targets. Yeah. Sorry.
No, no, please go ahead. This is your interview.
Because profit target, why I think that people love it is because they think that profit targets give you better stability in trading in general. But it's very, very far from being true, because usually what profit targets is doing is that they are not giving you the optimal performance in times when market is running like crazy. But if it is low volatile, if the volatility is not in the market, it won't even touch your profit target. So really, that I've made, I'm not talking about dozens, it's higher hundreds, maybe even lower thousands of tests on profit targets and stop losses in general. And what I'm always saying is that, firstly, if you don't understand what I'm talking about, I'm not mean you, but anyone who is listening to us, you should use stop loss for sure, because you have to have some risk management. Don't take me wrong, it's not about not manage your risk. It has to be always the first thing, but you should probably manage your exit which with some better way. And second, it's that stop losses, what I think that why it is not working, but it's just my idea, is that mostly retail traders are using it. And honestly, we know what are the stats of retail traders and their long-term performance. So yeah, usually the tool that most people are using is not working. And why we don't have to use targets or stop losses in crypto is because we run very small positions without leverage, and we hedge our positions. If I would run one single strategy of over leverage and on trend following, for example, I would probably use some hard stops too. But especially in crypto, if the market is volatile, it usually tends to mean revert. And that's why the hard stops in the market are the worst exit that you can imagine.
And the smaller the market too, the easier it is to hit stops or see stops on the market, and then people are trying to whack your stops. And not to mention on some of those crypto, like I know for me on Bitcoin, I have a 30% trailing stop on that position.
Mm.
So if I'm running an even small, like if I was in an even smaller coin, it could be 50, it could be
Yeah.
80%, like now it's getting to a point of why would I even run one in the first place? So,
Yeah.
it's different for everybody and what they're doing for sure, but the basic principles of what we talked about here of like it has to be wide, no matter what, it has to be catastrophic.
Mm.
Because if you and there's a reasons why people like us talk about profit targets not being great and why stop losses have to be wide. And people argue these facts with me all the time. And it's like, you and I are arguing the same thing. And the reason why isn't because this is something we feel. We
Mm.
back test this stuff.
Mm.
And then once
Yeah.
you figure it out through back testing, you go, oh my gosh. Like, for example, if I have a great trend following system on Bitcoin, I have a Bollinger Band model that I use, which is really good.
Mm.
It worked really well. And let's say I take my 30% stop, and let's say I move it to 15%. That system, its profits are just destroyed, and the win rate is cut probably in half. And I did this before. I actually made a post about it, like how you can't take a system and just go, hey, my stop loss, I'd love to keep a little bit more of my profits, therefore I'm going to run a 15% stop instead of a 30. Like and also when you back test things, you can go, okay, well, I have this system, it's working great, I don't have a stop loss in it. Then you
Mm.
put a stop loss in and you see, okay, and that's what I did on Bitcoin. Not to mention you study the volatility of the product, you ATR, however you do it, and you find out, okay, well, if I use let's try a 20% trailing stop in that same system, let's see how that works. Okay, that doesn't work that well. 25, 30, 35. Oh wow, 35, I still have the same exact profits, and I have a catastrophic loss in case something happens.
Mm.
Yes, it didn't hit it much. I only hit it like twice. However, in the future, you don't know. Like Bitcoin, like you said earlier, like we don't have that much data.
Yeah.
So it's really important. And also in the same angle of profit targets. If you're looking
Mm.
at profit targets, you didn't just say that because you feel that. You say that because when you, like you said, you back tested it hundreds of times on
Yeah.
different products, it just doesn't work.
Just shortly to stop losses, how to, for example, quick tip how to manage stop loss as risk management tool. Have different type of exit and then run the back test and look at MAE. Look at where basically the market gets against you. What is the maximum? Usually this is like 1 to 2% of trades that you can basically cut with some very broad stop loss. And this is usually the level where your catastrophic stop loss should be, because then it doesn't change the performance of the strategy almost at all, and you are somehow covered, yeah, protected basically.
Exactly. So before we go, one last thing, what if you were to tell your, someone who just started trading, they're just getting into this, they're going through that discretionary phase that we talked about earlier. What's something that you would say, hey, you should try this, or hey, here's some advice, or hey, read this.
Mm.
What would you tell someone like that today?
I would say that don't try to choose your style first.
Mhm.
Try to understand the market, because if right now, if I would like to make a switch to discretionary trading again, I know that with 9 years of really very, very thorough back testing and trading and making my research, I know that I would be much, much better discretionary trader, because through data, through testing, you will find out what market in general is about. So I would recommend trying to run or backtest or play with very, very simple models on different assets, because that way you can, for example, understand why trend following stocks to the short side doesn't make sense. These very, very common topics, but you shouldn't just read it, you should understand it, and you don't understand it without research. So you will need some very basic programming skills, but it from the start it can be only Excel spreadsheet. It can be enough to understand markets in general, and try playing with very basic models, trend following, mean reversion. For example, study Nick Rage books. This is very good start. Even Larry Williams, his very old models, doesn't matter in fact that much. Try with algo type of trading, even though you would like to be discretionary trader, because probably you won't stay with algo trading. If not, you will still be much better discretionary trader.
No, I love that, and that's great thing to end on, with the books and everything. Like it's a place for people to figure out where they can go and how to become better at this going forward, because and I think that's also a great thing you said too, that I hope everybody picked up on, which is, don't try to pick what type of trader you are, try to
Mm.
study the market first.
Plus,
Because I
plus,
think, go ahead.
if I can always think about the market as a place where everybody wants your money. It is really not simple environment. I want to take your money basically every day when I'm trading. I'm thinking about how I could take more. So this is, I would say, the purest form of capitalism,
Mhm.
and everyone is there just to make, or most of people are there to make money. And that's why you cannot think that you will try some double top double bottom type of formation and you will start making money. This is just not how it is working. So yeah, sorry to interrupt you.
No, no, that was perfect. I love that addition in it, because that's it's true, because if you look at it in any other way than that, you start to get stuck in your own ego. I have so many people who, the conversation comes up a lot about like the markets, trading, and saving the planet. Like,
Mm.
what if I'm doing this and I'm buying into this company? I don't want to buy that company. I don't like that company. Or I remember I had a client leave because we were long the energy sector at one point. I
Mm.
trade the sector futures, so we got long IXE is the ticker on the energy sector futures. Got long that, and then he got so upset about this, and I was just like, we're traders, and like they're not sitting there and pulling that money out and investing in anything. I'm gonna probably be out of it before that. What does
Mm.
it exactly matter? But however, this is how people like that sometimes think about it, and this is detrimental to trading, because
Mm.
then you're not running a strategy, then you're feeling things, and just running into whether we even bought solar a few years, or that was 2021 ish. So I mean, we've been long it here and there
Mm.
in that sector. It isn't about whether I like it or hate it. It's just another thing on my list. If we're price action traders, or quantitative traders and we're getting signals to buy and sell things, like we can't be picky about it. So I think that's also another thing that you brought up that's super interesting. But yeah, man, that's great. I love this interview. It was really good. I think anybody who's trying to put together a strategy and how they're going to do this well, like this is kind of a template. Um, and I don't know if many, like I've ever done a video like that where it's like here's a template basically of stop losses, systems, types of systems, like so I hope a lot of people get a lot out of this.
Yeah, I hope so. We tried.
Mhm. Well, thank you so much for coming on. This is a blast. Let's do this again if you have some time. I'd love to go through a couple more of these different strategies with you, because you run so many different strategies, and I think that's one of the coolest things to kind of chat about, which is why you run these things. We went over a lot of it today, but I know you have even more. And also let everybody know where they can find you because you definitely post all these strategies all the time, how they work, the drawdown periods, and so on. So how can people find you before we get off of here?
Yeah, well, firstly, you can follow me on Twitter, handles Pkycek, Pkycek. Then our website, robuxio.com. If you want to know more about our service, just go to robuxio.com/explainer. You can also get our newsletters. You can join our newsletter. Plus, we are giving out an article here or there in our article part of the website. So yeah, I'm trying to be very open, honestly, because from the start of my trading career, I really I really lost a lot of money just because I haven't had the right source of information. So I want to give at least something back. So that's why we are giving a lot of free information.
I love that, and that's the key. You only keep what you have by giving it away. Thanks so much for coming on, and we'll do this again soon.
Thank you for having me, Jason. Hopefully we'll meet soon.
Yep, and I'll put all the links in the description, by the way. So if you guys missed that, all the links for it will be on the description. You can find them all. Follow him everywhere.
Thank you.